we do not take any view on the resolution, the path of the resolution of the Russia and the Ukraine situation. However, in the event of a potential peace deal, the impact to the energy markets would be significant, but mostly via impact to the European natural gas prices compared to the oil market. So let me give you some context here. We have a pretty tight gas market this year. We've been raising our forecast towards $15 per MMBtu European natural gas pricing this year because the winter has been strong. And the market broadly stays tight in our baseline next year, and then a wall of new supply for gas hits starting 27, mostly from US, Qatar, and Australia. However, there are two-sided risks here to the gas market. Firstly, on the upside, if the power burn continues to be strong, we may need to see gas pricing move towards what we call as the oil switching range, which is near $25 per MMBtu gas pricing. However, in the event if there is a potential peace deal, then and there is a normalization of the gas flows from Russia through Ukraine to the pre-war levels, gas pricing may need to fall towards as low as $6 to $7 per MMBtu. So again, the gas market has a two-sided risk, and the impact of the potential peace deal has a much larger impact on the gas market compared to oil.
I know you're not supposed to take a position on this, right? But you got to wonder if that does happen, right? We get to $6, right, on nat gas. That's exactly what Trump has been talking about, right? Bringing the price of energy down.
Absolutely. So we are in a broadly controlled tape for the oil market, where we are still looking at Brent oil in a $70 to $85 per barrel scenario, and we are bearish on the long-dated gas market. Even without any outcome of the potential peace deal, we are still looking at a wall of LNG supply hitting the market starting 2027, and the gas pricing falling towards the level of $6 per MMBtu in order to create higher demand from countries like India, Southeast Asia, China. At a particular price level, absorption of the gas will go higher. So that is how we're going to resolve the gas market oversupply. And on top of that, we may need a scenario of a potential shut-in economics from the US as well, because the oversupply of gas coming is very large. A 400 million ton LNG market is going to become 600 million ton LNG market in 3 to 4 years' time. That's a lot. You can't just absorb this by creating extra demand at a particular price.
So who's going to be buying? Japan, that's likely. India, also likely. Let me throw this out there, right, as part of a grand bargain. China? Can you imagine that?
Well, China has increased its regas capacities for gas, so the import infrastructure has grown materially in the last few years. So we do see some sensitivity for gas demand to grow in China if the price points are right, or they are in the range of $6 to $8 per MMBtu. However, gas is still not going to be a major solution in their energy mix. They are still quite heavy on coal, and they're building out renewables, and they're building out batteries. So we do see eventual transition from coal to round-the-clock renewable, and the role of gas to be rather more limited in between. But there is still some sensitivity of demand to the pricing. However, India will be important in this equation to absorb through more LNG imports. They've been building pipelines and the regas terminals, and there is a price sensitivity in the industrial and the passenger vehicle segment. And also Southeast Asian markets will need to consume more gas as well.